What's up, everybody? It's JDew and Jonah of the Cash Compound, where we help you grow your wealth without ever locking your money up, losing control over it, or taking on risk. We're going to help you crack the code to cash flow. Jonah, what are we going to chat about today?
Yeah, let's talk about qualified plans. Let's talk about 401ks.
Okay.
Let's talk about the CARES Act. That's
right.
relevant to right now.
It is.
Let's talk about IRAs. Let's just talk about them.
Okay. So what's going on here for those of you who do not know? In 2020, the government signed a law off, I think it was in March, late March, with coronavirus and all that stuff that said, if you have fallen on hard times, which they really let be very broad for the average person, if you've fallen on hard times, gotten sick, gotten laid off, lost your job, lost business, whatever, you can take money from your 401k, your long-term plans, and your retirement, your investment plans. You can take money out of those things early, before you're 59 and a half.
Yep.
And you don't have the penalty, the 10% penalty that comes from an early withdrawal distribution, you do not have. So there's a lot of people who have asked us over the course of the year, what does this mean? We know you guys talk about banking, and we are understanding we have some leeway this year. We've also taken hits, right? People took some hits, some serious hits. And so they were trying to figure out some of those things. So we're going to do a little role play. Tell them how it's going to work.
Sure. So like always, I'm going to play the guy, maybe not like always, but today at least, I'm going to play the guy with a banking policy set for retirement. Okay. And you're going to play the guy with a 401k.
Got a 401k. Most of the people that we deal with have those through their work sponsored. They are. So we got to talk about what it is and some of the differences, just so you guys can understand what we're talking about sometimes. And then, of course, you can call us with your specific questions about your situation.
Right. And again, you're going to play the 401k guy that's going to be exercising maybe this CARES Act, right?
Yeah, I'm trying to figure out what I'm going to do as 2020 has a couple months left as we look at this. What should I do now? What should I do beyond 2020? How do these things kind of compare?
Right. So let's go back and forth and kind of talk about some real life topics and issues and see what's happening. So when we talk about again, a 401k, we'll give them a little background. Yeah. 401k's got to come from an employer.
Correct. Right? So a 401k has to do with those of you who are W-2 employees, and there is a retirement investment option with some of your income. So you're going to there's a couple ways to do it, as there always is. There's the pre-tax, there's the after-tax style. So the traditional, the Roth style, where I'm going to give some of my contribution into my long-term investment now today, and then I'm going to be able to go get it when I'm at least 59 and a half, and I'm going to start using that for retirement at the point at which I'm no longer employed, but this money was set aside for the long haul. That's the idea. That's what a 401k is. Most of you understand that. We're not trying to be super technical, as we always are, to make sure you understand. So that's what a 401k is. Most people contribute to those after the pension type plans have gone away for most of the non-government entity style, or if you don't play professional baseball, those are what you have.
Right. Okay, cool. So let's go back and forth. Let's compare and contrast. Let's talk about the real issues. So I always love to start with the fact that in my banking policy, I've got some guarantees.
Okay. So let me ask you some questions, because I've heard that so let me ask you some questions. I wrote some questions down. Okay. So I'm going to try to ask some questions in reference to the way folks ask us and you questions normally, but you may have to set the record straight about the way I'm even thinking. Okay. So first off is, not only does some of my money go into the long-term 401k situation, but my employer put some extra money in there that I didn't have to work for. So not only do I get to contribute, but I get free money going into my long-term retirement plan. So what say you there?
Cool. So employer match is normally
yes, I got a match.
Normally employers match up to a certain percentage, like 5 or 6% or whatever you're putting in, and they'll match it for you. So cool. So honestly, I got to go back to what I mentioned. I've got guarantees. Do you have any guarantees in your plan?
Well, I have guarantees that if I put in, like, sometimes, let's be a real dude here. If I put in 6% of my income, they'll match it up to 3%. So that's a guarantee.
From your employer?
Yeah.
But what about from your plan?
the plan.
Where they're putting the money. That's where they're putting the money.
Well, there's a great track record. It's been going up for years, right? And lots of people, they say that, right? So I'm saying it too.
They do.
So over the course of time, for the last few years, I'd say in the 20th century, the last 20 years, it's been averaging something like an 8% return.
Okay.
But no, there are no guarantees.
Okay. So my answer to your question is, sure, your employer's matching it, but if they can't guarantee your money, they can't guarantee any of the employer's money either. It's not guaranteed. So here's a follow-up for you. What happens if you switch jobs?
Well, if I switch jobs, then I'll roll it over to something else.
Okay.
So I
no
can
more
keep
match.
it. Potentially no more match if I go work somewhere else, right?
Okay.
But it's not like it's automatically taxed or taken out, right?
What about all the money that they put in when you switch jobs? So they call that normally like vested.
I have to check with my HR, I guess, on that one.
I'll help you out. Normally, you're vested after, it depends on your employer, but after 1 year, 2 years, or 5 years, they call it being vested. So they'll let you keep all the money that they put in. But again, that's a problem if you decided you don't like this job.
Sure.
And you want to leave, or you want to go somewhere else, or what have you. Okay.
Right. And most people, of course, they don't really know that. They only check in with HR once a year or less.
Sure.
So they have to go figure this out.
Open enrollment. They try to check in when they get the paper.
And they don't know.
When they get the email.
Right. Okay. So how about this one? Right now, so my employer, a lot of people say this.
Okay.
My employer is allowing me to choose from several different investment vehicles.
Okay.
All right. So I can choose from this plan or this plan or this plan. I got one right now I'm using. I really like it. It's giving me a good return or whatever.
Cool.
So what about me choosing what my money's invested in over in your banking systems?
Okay, cool. So I've heard of this before too. So normally it's like a low risk, medium risk, high risk plan, or like a
long-term, short-term, domestic, foreign.
Yep. They have like all sorts of options that you can choose from.
Stocks, mutuals.
Yep, absolutely. So I've heard that too. So here's the problem with that question. You said the word investment to me. And over here in banking, we don't use that word. Our money's not invested. So here's the problem with investment. You can kind of just look it up, honestly. Investment implies risk, and risk means you can lose money again.
Right. Sure.
Right.
I guess
so you got a good track record, but I don't like track records because, well, I do like track records, but I don't like track records on investments because investments, you've heard this before, it's a roller coaster. It's up and down, right?
Sure.
Like we mentioned, one of the reasons a lot of people are asking questions about this CARES Act, can I pull my money out? Can I put it in other places? Is because they lost money in the last 10 months.
Yeah. March, April.
Right.
Some people were really getting...
Right. I've talked to a few people that were 5 digits, 6 digits lost on those retirement plans.
Right.
And so sometimes that's like super heartbreaking for that person. And they're like, don't know what to do.
Right. Because it was a bunch of money and or the time they have left before they were planning to draw money.
I mean, if you lost 4 digits, 5 digits, 6 digits out of that retirement plan and you're 50 plus, I mean, that's not good. You're almost there. That was the whole purpose, right? And you just lost it. So here's the thing that I don't say it to them, but sometimes I do think it. Man, well, I mean, you kind of knew that going in. I mean, it's not like it was a secret that you can earn money and you can lose money. There's, like we just mentioned, low risk, medium risk, high risk. It's in the names of these plans that you're picking. Oh, well, I got my high risk, doing 8%, good track record. Like you can lose money. High risk, you can lose the money. So if you lose the money, again, like we're talking about, is there any guarantees? Will it always go up? Forgive me if I get it incorrect, but the last time that I looked at the 401ks, those can go all the way down to zero. Literally, you can lose not only what the employer is putting in a match, but you can lose your principal investment.
Sure.
Right.
Yeah.
That's a problem for me.
Right. If there's another option, on that, I guess.
If I'm counting on that, that's a problem for me because I'm not working, putting money in this plan or program or whatever you want to call it. And then I get to the time where it's time to go home and hang out with the grandkids and watch soap operas or whatever. And I don't have any money. Because I lost it. Oh, my track record this year. I'm not doing it. I'm not doing it. It's not worth it to me. But
okay.
So I apologize. So that was my answer. Long form answer. But yeah, you use the word investment. Investment implies risk. Risk means you can lose money. We just don't have that in the banking policy. So I don't have an apples to apples comparison for that question because It's like apples
It's not
and oranges.
Yeah, it's not apples to apples, is what you're saying.
Yeah.
Okay, so here's another one. What about taxes? Okay. So taxes are, if I've got a Roth, I'm putting my after-tax dollars into my plan, my retirement investment opportunity, my government-sponsored, company-sponsored issue. Yep. If I'm doing something traditional, then I'll be taxed later on growth. My tax will be deferred.
Yep.
So help me understand the tax consequences, the pros and cons. That's how my taxes work over here. How do your taxes work if you're going to try to impress me with the ideas of banking?
Okay. Well, there's just not going to be very many tax implications, if any, over here on banking.
Now, why is that?
The way that we design the policies is that you get to use cash value during your lifetime. So this is before retirement. All the cash value you use then is going to be considered a loan. Loans are not income in the eyes of the IRS. So there's going to be no tax implications like income tax over there. Upon retirement, what we do is we exercise a non-forfeiture option on your policy, which actually allows you to withdraw. Different word here. Withdraw.
Well, you said loans. Now I'm at withdraw.
Yeah. Withdraw all the money that you've put in up to the limit on how much you put in. They call that the cost basis. And all of that money, again, is going to be subtracted from like a collateralized death benefit that you have on your policy. So it's not going to be considered income. There's just no income tax over there. You're talking about income tax when you take the money out of their qualified plans, right? The 401k?
Correct.
Right. So
yes. The growth of the money, my money's growth is now income to me in retirement.
Right. So it's not happening here. So I've got a question for you. You said there's a plan where you can get taxed up front and there's a plan where you can get taxed later.
Traditional, Roth.
Okay, cool.
So Roth, traditional, the way you said it.
Okay, no problem.
Yeah.
If you get taxed later, if you choose that plan.
Traditional.
Okay. Do you know is it set to this tax rate right now, even though you chose later? Or is it going to be?
No, it's based on the tax rate at that time.
So if you're going to retire in like 20 years or 30 years,
right,
and the taxes keep going, taxes pretty much keep going up. And if they don't go up, granted, they normally just tax on more things, like they just add different caveats, right?
Yes.
So you're saying if you chose that option where you're going to get taxed later, you could have like way more tax than
I won't be making as much money then. So the tax bracket I'll be in will be smaller. That doesn't sound good. That doesn't sound great. But the reason I say this, because lots of people say that.
Sure.
They say, well, I'll be in a different tax bracket. And I just sometimes want to say to them, if you're in a lower tax bracket, that means you're making less money. So why are you asking me that?
Yeah,
that doesn't sound like a good plan.
That's not good.
People say it all the time.
Yeah.
Or that's what they're thinking.
Oh, no. Yeah, I'm with you. If you're in a lower tax bracket, you have less money. That's not good if you're trying to live. Oh, no, in retirement. Okay. Yeah, okay. Well, so you got no taxes over here.
That's all right. Okay, what about this one? Over here, I do have some contribution limits. The government has set contribution limits in this year, next year. So right now, if you're under 50, I'm 36, I can give up to contribute, including my employer match, I believe, 19.5.
Including the match?
I believe so.
That's crazy.
19.5.
Okay.
And if I'm above 50, which some of the people we work with are, then it's more. They add another, I think, 6,500 to that, that you can do each year.
Just a flat rate above that.
6,500, yeah. Okay. So that you can do. It's the catch-up stuff.
That's kind of weird that you can't decide, I want to live on less than my means now, so I have more later. They won't even let you do that. They put parameters on it. That's kind of crazy. Right.
That's the government has been kind of crazy for a long time. I didn't make it up. Sure. That's what the government made up.
I'm just saying that is kind of weird, isn't it? Like I can't decide. I'll manage right now while I'm healthy and active and I can eat less or whatever. The government
and then decide. Has my best interest in mind.
It doesn't sound like it. But okay, no problem. I got off track. You were asking me about contribution limits.
Correct.
I just found that crazy. So no. I'm sorry. There's no contribution limit. You can put in whatever you want to put into your banking system, whatever number you want to do.
Got it. Okay. So how about this one?
Big or small?
How about this one? I can change my contributions from year to year when I'm doing my work plan. 401k. Can I change my contributions from year to year in the banking system?
Sure. We've got some flexibility for you. We always build the policies where you can do a lower contribution. So normally if you're changing, you're going to do a lower contribution. That's what we're talking about because you've got maximum limits.
Yeah,
right?
guess so.
So we also have basically maximum limits based on the number that you chose, though.
Okay.
Based on your number, not just.
So my number is 19.5. So let's say I'm doing all that I can.
Okay.
19.5. So kind of what are you saying?
So same thing over here. So 19.5% of your income. So maybe that equates to, I don't know.
Let's just say it's $19,500.
Sure, $19,500. So if that's your number that you put into banking policy, that would be basically your max limit as well. 19.5, So you have max limits on both. You're saying I can adjust my contribution limit, which really just means come down because you can't go up. Right. So I'm saying the same thing. Absolutely, you can come down, but you can't go up. Now, there's a caveat to that over here. What we're going to teach you is how to bank with your policy, which basically is a workaround to be able to go up. It's basically what's happening. We're going to teach you to take loans and then put back into your policy more than you took out.
That's what you guys are talking about when you say financing all the time.
Exactly.
So
it's a workaround on how to get more into your policy.
Gotcha.
So that's how we kind of accomplish getting more in. But again, you can change, you can adjust and do lower, or if something happens and you need to just do less for a while. Sure.
Okay. So we're talking about my 401k. So that means we're talking about retirement by default. That's what it's for.
Yep.
I'm not normally looking to take money out early. Right. So,
well, if you do, there's a penalty over there, isn't it?
Yes. Okay. Now, we're all very familiar with that. There are penalties.
But not this year.
Not in this year.
Right.
So in 2020, right now, because of the coronavirus, there is the 10% is waived. Yep. You still have the taxes. I've got 3 years to pay that. So if I draw some money out,
you can pay the taxes over 3.
I can pay the taxes over 3 years right now. So I can totally split it up because, hey, I'm going through a hardship. The government's on my side. They're on my team, right? They're trying to help me out.
Okay. It sounds good, but we'll see it. I'll believe it when I see it.
Okay, so I get to retirement.
Okay.
The thing is about your plan, I've been putting money in at a frequency, at a clip, at a mode like every year.
Okay, sure.
So let's say it's $19,500.
Okay.
Well, I get to my retirement age. I'm 36, so I'm retiring in 30 years from now.
Okay.
So I don't have the same amount of income. So how in the world do I keep that contribution going into my banking policy? I'm not working anymore.
Sure. Well, the answer is you don't have to. Like we just mentioned, contribution limits, you can come down if you've got a different value now, if you got a different number. So maybe you don't have $19,500 a year anymore because you're not working, but maybe you've got 10 and you want to do 10. Then that's cool.
Oh.
But maybe you don't have anything,
right?
Because you're literally going home to watch soap operas.
Correct.
It's
I'm trying to hang out with the kids.
Okay. So
and I'm done.
Cool.
So how do I do it? I need income.
Well,
I'm not working.
The first thing is that it's possible. You can. What we like to do is it's a non-forfeiture option on your policy is what it is. You're going to exercise it. When you exercise that option, there are no more premiums, contributions into your policy at all. You're done. Your policy is still going to grow.
It's still going to grow. I'm not putting money in there.
Still going to grow on everything that you've contributed into your policy. You're still going to
for the last 30 years.
Yep. You're still going to get your annual bonus, your dividend.
Really?
You're still going to, yeah. And the coolest part is at that point, you're going to be able to actually withdraw, different word here now, the money that you've put in for that 30 years up to how much you've put in.
Okay, so I've almost put in, so let's say 20,000. So 20,000 for 30 years. So what are my cash values going to be when I can start doing this withdrawal?
So your cash values this is the loans that you can take out.
Right.
What are your cash values going to be? Well, it depends on if you've used your policy and banked with it or you haven't. But generically speaking, like if you just left it all in there for retirement to give us apples to apples,
apples to apples. I haven't been
just left it in there 30 years, $20,000 a year. I mean, maybe $700,000, $800,000, $900,000, maybe.
Okay.
Cash value?
Because you're saying that I can take the cash value, which is going to be higher than my contributions?
Right. That's how the policies are designed. Okay. So let's just call it $800,000 maybe.
Okay. $800,000 I can take as loans.
Yep.
And you're saying I can take out withdrawals of what I've put in. Right. That's what you mean by cost basis.
That's right. At the retirement aspect.
Yes.
Right. When you're ready to be done because you don't want to pay anymore.
Correct.
Yeah.
So that means in this particular scenario, I'll be able to withdraw $600,000
and take loans of $800,000. So 1.4.
So I'll have 1.4 for sure to use
at retirement. Yeah.
You're also saying that's the minimum because if I don't do this mysterious banking thing you're talking about, it'll be more.
Right. That's it. But you have a good track record. So that's cool. And your employer will match it, hopefully, if they can, right? If you don't move jobs before they make you vested.
Look, I'm not trying to work there forever.
There's no coronavirus again that eats some of it, right? I mean, that's
right.
That's what we're up against. Of course not. That's what you're doing now. No. That's what we've been taught to do.
You haven't heard of the 2030s.com boom again? That's going to be happening.
Okay.
I've been reading this book.
Okay. Good luck.
Okay.
Good luck to you. I'd just rather do my option. So I got some questions, though. I want to ask you. Big thing for me. Huge thing. What happens? You've been saving up all this money in retirement. You've been putting it into your plan. They've been matching you. You've been doing that for 27 years. And then, right before you're about to retire, you're gone. Something happens. You graduate. You're done. You go home. Not here anymore. What happens?
Then I don't need the money.
Okay. I like that answer. What about for your family? Do they get it? I mean, what if you're married and your spouse is about to retire? So does she get your money because you...
She could possibly. Now, some of the people out there know that. It depends on what type of plan you got. There are some certain aspects where your spouse can get to the money or some of the money, but not every time.
Okay.
And not automatic.
I got to be honest. For me, terrible answer. It depends on which one you have. That's awful. If I'm going prematurely, my spouse has got to get, I've been putting all this money in. My spouse has got to get this money. So you already know my answer. Over here, we're going to have a death benefit attached to the policy that's going to have been there the whole time. That's going to pay out to my beneficiary, probably my spouse, my kids, church, charity, whoever I put it to. It's going to be way more money than the 1.4 million that we're talking about. Probably 2 million, 3 million, and that's what's going to go out just in case something happens.
So you're saying that I put in 600,000, and there's going to be a death benefit on this, depending on a lot of factors like today, age, health, and things like that, on what that is going to be. Now, my death benefit when I started, let's say, is $1 million or whatever.
Sure.
How does that perform over the course of time?
It just goes up.
Oh, it goes up. Mm-hmm. Okay. So the spouse, the family, the friend, foe, church, charity gets the money. The death benefit.
I'm not going to choose any foes, but I'll choose my friends and probably my spouses.
Spouses. Got it. Well, don't have any foes, but I do have spouses. Spouses. Okay, so here's the question, though. What about all the cash value? So I got...
My cash
you
value
said I had like maybe $800,000 in cash value.
Yeah, but the death benefit is 2 or 3 million. I would rather have the bigger number, wouldn't you?
I'm just saying all these things that people ask us.
I'd rather have the big number.
You know as well as me is people ask us that question all the time.
They do. I think I actually got asked that earlier today. The death benefit's bigger than the cash value, so you're going to get the bigger number. The insurance company's going to... You got your best interest in mind.
Okay.
And give you the bigger number.
All right.
Cool. What about this question? Is your retirement plan, is it safe from creditors? Can creditors get you?
Depends. Once again.
What about like if you go through a lawsuit, a divorce?
Right. So no, it is not safe from that. No. People can get to that.
People can take it?
People can get to that.
Wild.
For sure. So we're mostly talking about 401ks, and I know there's other type of qualified plans out there with other numbers. Lots of them have 4s, 403Bs, 457s, and things like that. Mm-hmm. But we're talking about 401ks mostly. So
just so you know, just in case you didn't, those numbers refer literally to a specific section of the tax code. Is what those numbers... That confused me for a while.
So the reason is those are exceptions to the tax code. Right. Remember, everything is income that you make, that you work hard for, and the government has the ability to come get some of it unless they qualify certain things for you.
Areas of the tax code.
Areas of the tax code. That's what these things are. So it's also important for people to remember that the government can change what these things are. We're talking about contributions there for a minute, and the government makes them go up, makes them go down. They can do all sorts of things with that. So just remember that.
They normally change that like yearly, normally.
Yeah,
yearly
it actually,
years, they bounce it up and down.
They do.
Which is kind of crazy.
Yeah. Sure.
I mean, you're saving up for your retirement and then they drop your limit on you or something.
They could, of course. And a lot of these qualified actions are less than 50 years old. So they're not that old.
Yeah. I'm just thinking through it now. They change. I've literally seen the limits change. Like, oh, it's up by $500 this year. It's up by $1,000 this year. So. But people really sometimes don't think that they're going to change the taxes on it. They change the limits literally every chance they get. They're going to change. I mean, somebody's going to come around and change the tax on it, and then everyone's going to be mad, and you're going to lose money. I mean, it seems inevitable. They literally change it every year.
Yeah. Well, I think the checks and balance system is that by the time you are of the age where they start messing with your money is when you're really lobbying for certain people in Congress. Right. I honestly think that's what it is. So the time where they're about to mess with my money is when I'm most concerned to get the favorable guy or girl in the office.
That's wild.
Okay. You have any more questions for me?
Yeah, I think that at some point...
What did I miss? Yeah, what I should have asked you.
At some point, if you keep your plan, which, it doesn't sound great at the moment, but if you keep your plan, you decide you want to keep it, don't they make you take money out at some point too?
Yes, there are minimum distribution times. So normally when you get to like 70, sometimes 72, they require you to take money out.
Okay. What if you didn't want to take that much out because you were planning to be alive a little bit longer? You wanted to have this much for something or...
Well, the way my health is set up, I don't have a great track record, so it's okay. I'm going to start taking it out at 70 years old, and I'm going to die at 80. Because the moment I run out of money, I'm going to die. I'm not trying to play the game any longer.
This is a tough scenario to be in. If that's if that's your plan. There's a lot of holes in the plan. There's just a lot of ways you can lose money in the plan.
Sure.
Like literally, we talked to like 5 or 6 of them. You can just lose. They can just change the rule on you. You can just lose it because the market went down.
Well, let me ask you a question. What can't they change the rules on these insurance programs that you're talking about?
They can change a few things, but not really the rules. So when you start a banking policy, you're going to get an insurance policy contract. So, I mean, that's a legal document, I guess. I was going to say tender, but that's not it. Legal document, legal contract that you're literally going to sign. They call it a unilateral contract, which means as long as you sign it, the insurance company has to. Basically, it means if you keep up your end of the bargain, they have to keep up their end, contractually obligated. Of course, your end of the bargain is just contributing what you said you were going to contribute, or adjusting that contribution but giving them something, right?
Yeah.
So that's your end of the bargain, and then their end of the bargain is that, those guaranteed growth and the guaranteed cash value and the guaranteed death benefit and whatnot. So some things they can change are like the bonuses, the dividends every year. Yep. They can adjust and change that. Now, we don't normally use any insurance companies at all that have a track record of adjusting and changing things. We like insurance companies that have been doing it steady. In fact, off the top of my head right now, the least amount of time of an insurance company that we use that's been given out a dividend consistently is like 96 years or something. They've just never had to stop doing that. So again, they're changing your stuff like every year. They're not really changing ours. It's been a while.
I guess so.
Yeah. 1930 something. It's been a while, but they can adjust like the bonuses, but again, hear me, bonus. They can adjust that. But yeah, the rest of it's kind of in the contract. Okay. So they're not allowed to change it on you.
Gotcha. Mm-hmm. All right. What else do I need to know if I'm saving money and investing money for my retirement future in something like a 401k?
Well, I think it's just the time that we brought this video to you. It's really good to know that this year, if you've got any sort of hardship, can claim that it is a good time to make that decision to maybe jump ship if that's what you want to do, because you don't have to pay the penalty. So a lot of people maybe start contributing and they realize they don't want to. They're contributing too much. They want to do something different, whatever it might be, and they don't realize how to get out of it. But a lot of people have taken advantage of that we've spoken with this year just because of the lack of penalty this year and the deferment on the tax. You can pay that over 3. So lots of people are doing that. If that's you, then we want to talk to you and we want to walk you through it or answer your questions or give you more specifics, pinpoint what your questions are, and just let you know how we can be helpful and how we can set you up with a banking policy that can still accomplish your retirement goal. That's important. Still accomplish your retirement goal, but also you can buy some cool stuff, pay some stuff off, accomplish some financial goals in the process. So we can do actually both over here, and we'd love to talk with you about it, but that's what I think you that's what I think we wanted you to know. So thanks for tuning in to another Money Mathematics episode with the Cash Compound. Of course, you can find these inside of our course on thecashcompound.com. We've also, of course, got them on YouTube where you can watch them. Thanks for watching. Tune in. Please leave a comment, like, subscribe, email us. We want to talk with you, and we'll see you guys next time.